Hey everyone, and welcome to this explainer. Okay, so we are tackling a massive topic today, one that's pretty much dominating every financial conversation right now. It is May 2026, and the S&P 500 is hovering in totally uncharted territory, right around that 7,300 mark. I mean, that is a huge headline number. And whenever we hit these record-breaking levels, there's always this undeniable energy in the air, right? But it's also mixed with a really healthy dose of uncertainty. You see the constant headlines about AI innovation driving markets higher, and you're probably just trying to figure out exactly how to position your own portfolio for the rest of the year.
Which brings us to the million-dollar question. How are you actually supposed to invest right now? If you're looking at these sky-high valuations and feeling a bit hesitant, trust me, you are not alone. It can be incredibly challenging to deploy your hard-earned cash when everything looks priced to absolute perfection. So today, we are cutting through all that noise. We're going to build a comprehensive, hype-free guide based strictly on our current economic reality. This explainer is totally designed to help you adapt your strategy to the 2026 climate so you can make smarter, much more confident money moves.
Okay, let's dive right into this. Here is our roadmap for today. Number 1, the current market reality. Number 2, core investing principles. And number 3, your practical action plan.
So, kicking things off with Section 1, the current market reality. In short, it's strong, but man, is it expensive.
The S&P 500 sitting at roughly 7,300 is incredibly impressive, but we really need to look under the hood to see where those gains are actually coming from, because this isn't some broad, equal opportunity rally we're seeing. These massive gains, they're heavily driven by artificial intelligence and just a handful of massive tech companies. The innovation in AI is undeniably boosting corporate productivity, and the market is rewarding a very concentrated group of tech giants for it. So yes, the market is remarkably strong, but it is extremely top-heavy right now.
And then, pivoting to the broader economic context, we're dealing with inflation that is hovering stubbornly right around 3%. It's sticky. While we thankfully aren't seeing those massive, scary inflationary spikes of years past, getting that number down to the absolute ideal target has proven incredibly difficult. This 3% reality means there's an underlying current of persistent inflation that's still quietly eroding purchasing power, and that directly impacts how we calculate your real returns.
And because of that sticky inflation, the Federal Reserve is holding interest rates steady right between 3.5 and 3.75%. Those rapid rate cuts that so many analysts were expecting, they simply aren't arriving. We have officially entered and are firmly sitting in a higher-for-longer rate environment. This completely changes the underlying math on, everything. It changes how companies finance their debt, how consumers spend, and crucially, how you should be looking at yield across different asset classes.
So, this basically creates a massive tug-of-war in the market. On one hand, the good news. We have a genuinely resilient economy, and AI-driven productivity is creating very real opportunities. Corporate margins in certain sectors actually look fantastic. But on the other hand, the reality check hits. We face sky-high valuations, sticky rates, and this entrenched higher-for-longer environment. When gains are concentrated in just a few massive stocks, but overall market valuations are totally stretched, a diversified strategy becomes absolutely non-negotiable. You simply cannot afford to be overexposed to a single narrative right now. All right, moving on to Section 2, core investing principles. Basically, what is actually working right now? We've got 4 golden rules for this specific environment. First up, you have to stay invested and maintain disciplined dollar-cost averaging. This removes the emotion from buying into an expensive market. Second, diversify beyond U.S. tech. Because the market is so concentrated, you really need to branch out into international equities, small caps, and defensive sectors like healthcare. Third, prioritize quality. Focus on companies with fortress balance sheets, strong cash flow, and real earnings, not just speculative hype. And fourth, use bonds and cash wisely. You want to leverage the decent yields available right now to strategically balance out your portfolio's risk profile. To put that into perspective, if you want a balanced, middle-of-the-road risk profile, the classic 70-30 allocation is highly effective today. Having 70% in stocks gives you the market's growth engine, so you don't miss out on secular trends like AI productivity. Meanwhile, keeping a solid 30% in bonds acts as a necessary shock absorber. It provides ballast and income for when those stretched tech valuations inevitably trigger some broader market volatility.
Now, shifting gears to a more growth-oriented model for longer time horizons, you're looking at something closer to 85 or 90% in stocks and 10 to 15% in bonds. But here is the absolutely crucial point. That massive equity slice cannot just be 5 tech companies. It has to include broad ETFs and significant international exposure.
You really want to capture true global growth and widespread economic resilience, rather than just trying to ride one single localized wave.
And finally, the more conservative allocation. 60% in stocks, with a really robust 40% in bonds and cash. Honestly, in a higher-for-longer rate environment, this setup is incredibly attractive. It allows you to lock in the genuinely decent yields that are currently available across fixed income, without exposing nearly half of your wealth to current market premiums. It's a highly defensive posture, but one that still captures a reasonable amount of upside.
Which brings us to Section 3, your practical action plan. These are the exact steps you can take today. Okay, let's translate all of this theory into real action. Step 1, pay off that high-interest debt. It is incredibly toxic in a 3.5% plus Fed rate environment. Step 2, build or optimize your 3 to 6 month emergency fund by keeping it in a high-yield savings account to capture those current rates. Step 3, maximize your 401k match. That's literally free money, and fully fund your Roth IRA to take full advantage of tax-advantaged compounding. Step 4, automate your asset allocation across broad market indexes, using funds like VTI and VXS. In an expensive market like this, having automated inflows ensures you keep buying through those inevitable 10 to 20% corrections without any of the emotional hesitation.
You know, at the end of the day, it really all comes back to the oldest, truest adage we have in finance. Focus on time in the market, not timing the market. 2026 absolutely demands discipline. High valuations combined with rapid technological innovation create a fundamentally volatile mix. So don't fall into the trap of overtrading or chasing whatever the daily narrative is. Stay consistent with your automated plan, stick to your targeted asset allocations, and just let long-term compounding do the heavy lifting for you.
So as we navigate these record highs and stubborn interest rates, the question isn't just whether or not you're invested, it's how resilient is your strategy. Take a hard look at your current allocation today and ask yourself if it's actually built to withstand the unique pressures of the 2026 landscape. So what is your biggest investing question for 2026? Drop it in the comments below so we can keep this conversation going. Thanks so much for joining me for this explainer. Keep analyzing, stay disciplined, and I will see you next time.